Yeah, to start with, a few words about NAS. NAS is a real estate investor and asset manager with offices in Berlin and Frankfurt. We operate in the residential and the commercial property sector. Now we have primarily a focus on office buildings, and we are on the sell side with respect to residential. I'll tell you later why.
Okay, great, thank you.
Yeah, my name is Christoph Eismann. I'm working for ASM, which is the sixth largest audit and accounting firm in the world. I'm focused on tax. So with regard to real estate, I'm working on how to set up a project in an effective manner from a tax point of view. And I'm also a member of the ASM European Real Estate Desk, where we try to coordinate and cooperate with tax experts from Europe.
Christian Bischoff, founder and managing director of LLI Projects. We're focusing on the asset classes logistics and light industrial, and we're developing big warehouses as of 20,000 square meters and more, preferably in core markets in Germany and surrounding countries.
Okay, great. Tobias.
Tobias Schultheiß. I founded Blackbird Real Estate in 2011, say 6 years ago. We are a transaction advisory boutique acting from Frankfurt. Advisory boutique meaning whatever our clients, mainly international clients, give us, be it a 100 million office park portfolio or a portfolio of ATU service station, to sell this asset by asset. Our core competence is that we have the ideas to sell any complex property.
Okay, great. Christian.
Christian Eder. I'm from Invesco Real Estate. I'm working in the research department there, and we roughly manage 8 billion euros in Europe across many countries. We have 8 offices across Europe, and we are based here in Germany. Our office is based in Munich.
Okay, great. And you may have noticed that Marcus is not digitally represented here, which is entirely my fault, but fortunately, he is in the room, which is much better than simply being a picture. So, Marcus.
Thank you, yeah, we jumped into this quite spontaneous, like we sometimes jump in transactions, so probably that's good. Yeah, Markus Drees, I'm the CEO of DEMIRE, that is DEMIRE Deutsche Mittlestand Real Estate AG. We're a listed commercial real estate company based in Langen, so in a secondary location next to Frankfurt, and we're focused on secondary locations, so we buy office, logistic and retail assets in secondary locations.
Okay, great. Nikolai, maybe starting with you. I mean, Germany in general has seen a very positive economic outlook at the moment. It's seeing growth. Do you see that continuing? We've just had elections. Was there any issues with that? From a cross-border perspective, do you see that growth continuing in Germany?
So talking about the German economy,
yeah,
is that the question? I would say yes. What we have seen over the past years is obviously a positive development, which has evolved and happened for various reasons. Exports, of course, a big factor to it, but also consumption, private household consumption. What we haven't seen so much is government spending. So some people keep asking, okay, what's going to happen if the entire export industry is suffering, and we see challenges. We see China obviously catching up on various things. The Mittlestand that we are also investing in is potentially going to be affected to a large extent, but what we see, I think, is a longward trend. We don't see a situation where we have 2, 3, 5 years of economic development. We see basically a highly competitive market. If you consider labor cost, average labor cost in Germany, compared to other European economies, then you will see that these are very low, and they have been falling over the past 10 years as an effect of reforms that have taken place a long time ago. And what's going to happen, in my view, is that if maybe private households and companies don't spend that much anymore, government will step in. It has basically been challenged with respect to infrastructure spending. and that hasn't happened. So there's a very balanced household. And in my view, if there's any shortfall in those other factors to the economy, the government will start spending and make the German market attractive from that view also. So we're talking, I think, for the time being, about a very, very strong foothold and a very strong fundamental situation.
Okay, good. Maybe to you, Christian, you're obviously, as well as being based here in Germany, so having an eye on the German market, you're also looking at European research.
Yeah.
So how do you see Germany at the moment within the context of the other European nations that I guess are also competing for investment?
Yeah, I mean, what was already described in terms of the fundamentals, they are really very intact in Germany. Also going forward in terms of GDP growth, etc., while it might not appear too exciting from some countries, growth of potential of roughly 2% for Germany is quite a good standard. It's already above what you could expect in terms of demographic profile. So the overall situation is very sound. The government has the firepower also to act. And in a pan-European perspective, while there are economies like the Eastern European countries, which we are basically neighboring, which have better growth potential because of base effects, Germany overall is very, very sound in that regard. So I completely can echo that, what was already described.
Okay, good. And Christian, I mean, it should suggest in a way encouragement for logistics. If you've got an increase in that, both I guess from the side of positive manufacturing, but also demand. So how do you see the market from your sector-specific view?
Great. I mean, you can always find the hair in the soup, if you will. But no, we are experiencing great market conditions over the last 3-4 years already, and with the low interest policy of the European Central Bank, I don't see for the next 2 years anything that slows it down. And that Germany now in 2017 already has been announced as the prime first biggest location for international investments in Europe, racing UK again, is only a symbol for that. I mean, if we want to complain about anything, I mean, that's, you know, I mean, if you're not happy with this situation, you will be never happy with any situation.
One of the things, certainly from my perspective, based out of London and Amsterdam, is that there was an awful lot of reporting on the kind of rapid rise of the right in terms of the AfD. Is that being outplayed? Do you think is that being sort of, is it just newspaper coverage really, or is that impacting a little bit on the perception of investors coming in? Has that been a question in terms of your clients when they've been looking at Germany? Yeah.
Well, first of all, I have to mention that I'm also not satisfied with the fact that the right wings populists have gained about 13% of the votes. But on the other hand, I mean, it's not a development that took place just in Germany. It's a movement that you see all over Europe. For example, in the Netherlands, there's been Mr. Wilders for several years. In French, we have Front National. So it's not unique in Germany. So I don't really think that it's going to have a really strong effect with regard to investment.
And in terms of the kind of reported difficulties of being able to achieve a coalition and that taking a longer time, is it a bit like in Belgium or in Holland in some ways that actually it functions much better without a government? What's your sense of that? Is that an issue or not really?
I mean, there's a basic understanding from all parties that they don't want to form a coalition with the AfD. They have only 13% of the vote, so there are other options to form a coalition. So at the moment, that they are not part of this process.
Okay, good. And Tobias, I mean, we covered this topic last year at Expo Real. Just in terms of the market, are there particular things that you've seen either in terms of investor demand for the types of sectors or investor demands for the types of opportunities, things that you've seen that are a big change over the last 12 months?
not really a big change. There's still massive demand for CBD trophy properties. There's still high demand for logistic development, housing, student housing, so that the established uses. But looking at what Nikolai does with NIS Invest, or also Marcus with the Mire, I think the outcome of this over demand over the last 10 years is that a lot of investors now understand Germany is not only the top 5, top 7 cities, it's also cities way beyond what we call B locations. It's, I would say, cities starting from 30,000 inhabitants upwards are good cities to go to, not only for a Rewe or a Lidl discounter market, but also for office, for business parks. Because when you find healthy cities, then you can also go and buy in these locations.
Yeah, go ahead, yeah.
We see for the last 4 or 5 years already statistics that logistics developments by square meter and by value outside of the top 5 or 6 cities are much bigger than before. So Germany has already reacted on this. I mean, we don't have this, town like London or Paris, which is so overwhelmingly for the whole country. We're a federal state, and even Berlin is big, but not that big. So you have other centers like Munich, like Frankfurt, which is the highest performing market in logistics. And we have Cologne, Düsseldorf, Ruhr area, and Hamburg, plus a lot of mid-sized centers, starting with Hanover, Nuremberg, and others. And so there is a broad development in a lot of different cities, which is very healthy, I think. Yeah, and which also is a basis for success in e-commerce and same-day delivery.
Okay, good. I'm going to pick up the same-day delivery shortly, because I think that's a really interesting topic. Marcus, just from your sense, are you then seeing, like picking up Tobias's point, are you then seeing more, not just more activity and opportunities, but actually more interest in these B, C, smaller cities, just picking up Tobias's point?
Yeah, we do so. So we defined that for us as secondary cities to make it easier for us to tell everybody investing without the top 7 cities. What we see is that the top 7 cities became relatively dry overall asset classes, that the money now is swapping into secondary locations, so in B locations, because people see the demand, and if you take a look at secondary locations like we did together with Bulvin Gesa, for example, you will see that the average vacancy in secondary location is lower than in the top A cities. The reason for that is that you will not see speculative construction work going on in secondary cities, because that doesn't make sense without having a tenant in place and agreed on something before, because the level of rent that you can reach in secondary location doesn't make it so attractive to build something new. So for that reason, from our point, and that's what we decided when we started investing in secondary location, it makes more sense to acquire used assets for less than 1,000 euros, for example, than to build something new for north of 2,000 euros. So overall, we see that a lot of players and investors recognize that and start investing, or starting more to invest in secondary locations, yes.
And maybe to add to that, it's always about jobs, right? So you need to take a look where are actually jobs created in the country, and it's not necessarily in Berlin or... Okay, Munich is a bad example. There's jobs obviously created in Munich. Take BMW as an example. But in Germany, you will find a decentralized structure, and you will find cities where the Mittlestand and the backbone of the German economy basically has its headquarters, and that's basically where people go. And that's where real estate is needed, not only for residential, but also for offices. And from that perspective, it makes perfect sense to look outside the top 7 and really not take the case of France or England, but to look at Germany as a more decentralized and more diverse market, and then really to make sense where to go and to look at the fundamentals, not only from a demographic but also economic perspective.
Okay, great. Yeah, I'll pick up you and then you, Christian. There's two Christians, aren't there? So
No, I just wanted to mention, because he said jobs. Mostly in B locations, you have the chance to get the jobs you need for having your warehouse or your production operated. Yeah, we have here in Bavaria, we have areas where unemployment rate is 3% or lower, which means you're basically talking about full employment, which is really an issue if you start coming up like e-commerce, big warehouses, 1,000, 2,000, 3,000 people working there. Okay, where do you get them from? I mean, if you look at Amazon, they have bus lines organized where they carry ships the people from 100 kilometers away to their shifts in order to have the jobs filled with people. They're now not only going to cities where universities are with at least 40 or 50,000 students, otherwise they will not come.
okay, good. You wanted to pick that up, yeah?
I mean, I just wanted to add, in terms of this polycentric element we discussed, what we also always look at is the live, work, play environment. It's a nice catchphrase, I know, but I think in Germany you have lots of places beyond the top 7, like Freiburg, etc. They have this quality of life. Münster, those places where you also find the talent, you have the universities, you have the structures, and of course they're also interesting places to invest because of that.
And one thing I wanted to pick up, Invesco, obviously, across a range of products in a way. In terms of core investment in Germany, are you finding yourselves priced out of that market? Are you finding yourselves moving towards pricing that maybe a year ago you would have thought, I'm not sure?
To be fair, I think we are now on the very bottom end in terms of core products, in terms of yields. What we see in Berlin, Munich, Hamburg, the 3% mark, I think it's a keen statement also for our investors. So we are looking a bit beyond the very core product in the CBD. We are moving a bit further out to very well-connected sub-markets which have the infrastructure, which also have the amenities. But the CBD prices, yeah, we find that hard to match. That's true.
Okay, for you, Nikolai, is it when you're looking at these, either the secondary locations, or are you really looking to put asset management to work on that in order to change those, or are you looking for higher returns? What's the strategy?
So first of all, with respect to the secondary markets, yes, we have a focus on secondary markets. Having said that, we just bought a building in Munich, we just bought one in Hamburg. So these are actually the top 7 locations, but they're, again, not CBD, but in good micro locations. And what we do basically is we target those deals that are a little bit below the radar of those large institutions. We have a focus on 10 to 25 million deals, you can say. And that's where we find the best yields. So the situation there is a little bit different from what you see in core, what you see potentially in trophy assets. Now, we have an advisory board consisting of Steffen Vricken and Oliver Zimper, who do trophy assets in Germany. So I get a sense, although I'm not immediately involved, I get a sense where yields stand and where they're going. And I have to say that there's a high risk, in my view, involved in those core transactions because you're potentially overpaying. So if the market turns, there is a large challenge to actually cope with that and to make sure that you're still creating the value that you would need to create to get to those target returns. And there's 2 components to it, obviously. There's the rental growth, and then there's yields. So you need to do a lot of asset management work on the ground to make sure you're creating that rental growth to potentially offset a downfall in those yields. Yeah, if there's yield expansion, and who knows, it might come. And then you don't want to be there, losing 10 multiples on your transaction. I think it's very hard to catch up. So from that perspective, we feel more comfortable in buying, in those markets, let's say the secondary markets, or in micro locations that are outside the CBDs. But then we're talking about 6 to 8% yields. And obviously, this is something that we would need, that we find through our network in the market. It's not something that you raise your hand and here I am. Please send me a deal. It's something that evolves over time, But then if you have that access to the market, and then you can create additional value through active asset management, lift those rents, mark rents to market, then I think the downside risk is actually pretty limited, whereas you can create attractive cash on cash and then potentially also higher IRRs if we're approaching the next peak of the cycle.
Okay, good. Tobias, you wanted to pick that up and then you, Marcus. Yeah.
I absolutely agree with what Nikolai said. And just recently we bought 2 properties in small cities with 30 and 40,000 inhabitants at a blended rate of 9%. And when I did research on it, I found out that one of these properties over the last 10 years had a stable income of 300,000 euros with a range of 5% up or down. But all of these leases were on short terms, so you had a stable leasing situation. And I always ask myself the question, so when you buy a skyscraper in Frankfurt at below 4%, where's the money? Maybe if you're lucky, you can sell the property at the same price you bought it. But if you're unlucky, then you'll really lose money, but had a landmark building for a couple of years. So if this is the return, then you did a good investment. But I never understood why one should buy these skyscrapers in Frankfurt. I always preferred the smaller towns, smaller cities, where you may not have the added value perspective, but you have a stable investment and you create wealth by paying back the mortgage via your tenants.
I mean, and it's interesting. Did you want to pick that up, Marcus?
At least I just want to say that once you are investing in secondary locations, you have to be clear on the point that you have to allocate some attention from the asset management perspective on your assets. I think buying an asset in a top A location, having a tenant for 15 years, you can manage that as a couple of people did on a fly-in basis. But if you acquire something in, I don't know, Leipzig, Bremen, you name it, you have to have your attention on that. You have to take care, you have to be there, and that's the reason why these assets offer you high yields, but they also need more attention from the management perspective.
And Christian, I just wanted to pick up with you in terms of the research side. We've mentioned a little bit that maybe it's difficult for capital to find proper returns at that kind of core end, but plainly, Brexit as well has created more of a focus on continental Europe and therefore more of a focus on the very remaining stable Germany. So where's that money coming from, and does it make sense for them to be at these kind of core levels, or is this about getting the money to work?
To be fair, I think it's quite a broad interest. It was also pre-Brexit that Germany kind of came on the radar. I mean,
I'm not saying it's only because of Brexit.
No, but I think it puts some additional focus on. That's absolutely true. And but in terms of the sources, we see as Asian capital as well as North American capital coming in different styles, with different profiles. So that varies a lot. But we also seen capital coming from Asia still having kind of return requirements which are not able, which don't work with very core assets. So this capital is already kind of educated enough to move beyond the, say, you name it, Frankfurt, Munich, Hamburgs, Berlins. They are also moving a bit, or in those cities, they're moving further out. So they're not looking only for the core asset. They are also looking for a working return in a decent location. That's what we found with those clients. So it's not about the landmark buildings anymore only.
And are they prepared to go into these? This is for anybody, because it may well be. I'd be interested to know if you're beginning to get different sorts of capital, beginning to look at those kind of situations, the sort of BC cities. Are they beginning to look at that, or is that a step too far at the moment?
I think for me, what we see, it's still a step too far because of a bit of less transparency also, to be fair. I think the transparency beyond the top 7 is getting a bit less, and Germans are more used to operating in such environments, like you mentioned, Leipzig, Bremen. They are more used to this structure, whereas some of the more international capital, they would love to have a bit more transparency. That is at least what we find right now still.
What I would add is that bank financing gets the percentage of in the whole transactions in our asset classes gets less and less. We see much more alternative money out of insurances and out of other fund structures, while banks is getting less and less.
Okay, is there availability of finance for the sort of B and C sectors?
I just want to add that we started doing a study on secondary locations with Bulwi and Gesa, and then TLG did it. Yeah. And I think this is one of the first steps that you see in the market when the market starts researching in secondary location, this is helpful because all the foreign investors are not that well educated of this polycentric structure we have in Germany, and so it's quite helpful that they have some comparables and some numbers so that they are also able to understand what we are doing, to invest in a listed company or to invest in direct investments.
Okay, good. Nikolai.
Talking about transparency, I mean, look at the German market 10, 15 years back and you will see probably no transparency or very few transparency, even in the top markets. I mean, take the German real estate industry. In the 90s, there was almost no international investor. And of course, this has changed over time. I mean, as the German economy has developed, as you know, the whole industry has internationalized. I mean, back in the days, I don't think we would have sat here and talked in English over the market. There was a totally different, totally different mindset. Germans dealing among themselves. Obviously, the market was not as fluid and liquid as it is now. So the entire industry has developed and become more professional. And in conjunction with the economy, this has led to international investors entering the market, obviously. I mean, there used to be a language barrier. It's not there anymore. And obviously for internationals, it has become much more attractive to be active in the market. And we, for example, see this in particular from Asia. So we have now started a cooperation with a company in Hong Kong that's basically marketing our investments to Asian investors. And there is appetite. There is appetite. And why is there appetite? Because, on a side note, because of Brexit, of course, but primarily because the market has become attractive from its fundamentals, but it has become accessible to internationals, and that's the main factor, and it has become more professional, and for that reason we're sitting here, and that's why we're discussing this topic, and those are, the overall developments, and those are beneficial for international capital flow, of course.
Okay, good. I want to pick up the point on international capital. Christoph, obviously you're sitting in Germany, but RSM is a big international network. So in terms of the investors, capital from abroad that is kind of you're advising, I guess, in terms of their activities here in Germany, have you seen a change in those clients? Have you seen new clients coming in, different types of capital looking for different opportunities?
I mean, we've seen in recent years, especially investors from Asia coming up that haven't had Germany on the radar before. For example, I mean, there are all size of companies that we advise. For example, like very famous is a Samsung Group who bought the Commerzbank tower in Frankfurt for 700 million. So I guess that's one thing we've noticed.
Okay, good. I want to delve a little bit into the sectors for those of you who may be sector specialists. Let's start with you, Christian. In terms of the logistics sector, how big a driver is in e-commerce? You've obviously had Amazon Prime, Amazon Fresh, and I believe now kind of same-day delivery beginning to come in. What's the prospects of that? Is that really driving forward logistics?
Yeah, it's. I think you see the big retailers having a multi-channel strategy, and you have to say one thing, of course. Same day will come in the big cities and the big agglomerations, but anyhow, there is a building right and building law in place that also the communities look very detailed into. And you cannot just go and get the building permit for a 100,000 square meter box somewhere and then just start to build it. You have to convince town councils and mayors and so on that this is a good investment in the neighborhood. So there is no explosive thing, but what I see in the recent years and to come is definitely, same-day delivery is a killer application for the stationary retail. It will coexist. It will come more and more, and so we see a strong development, a strong demand for logistics warehouses. We also see a lot of production facilities which are outdated, need to be refurbished, and production today is material flow, so it's also warehouses. And yes, we have in the sector solid growth, no bubble at all, because every deal has to really be appreciated by the community where you buy the land. So we're very comfortable, no bubble structure at all, but a strong growth.
Okay, good. Obviously, Invesco invested in across the sectors, basically. What's your kind of view on Germany in terms of, I mean, also pick up the point from there, do you see retail also coexisting with e-commerce, omni-channel in that sense, and that those sectors are still strong?
I mean, first of all, the German consumer, it's a very positive situation. German consumers, for the first time in the last years, saw real wages grow for 1.5 decades. So that's a positive. However, most of this additional spend is going into the e-commerce. That's clear what we see. So what we as Invesco prefer at present is rather, when we look for high street retail, rather go a bit for more the luxury end, because the mass market, what you see in the fashion in Germany, they're a bit struggling, to be fair, because they see this change coming. So retail is a bit of a mixed bag where you look at. But in terms of the other sectors, I just can echo also for, I think, the office market, what you described for logistics, because of the planning regime and everything, pipelines are relatively modest, and also going forward, the competition of use, especially in the big cities for apartments, creates some pressure to build additional apartments, which means this space is not there for offices or other developments. So that's something which is at present, I think, also driving the market. And I think the housing market is also one sector which is clearly in focus also politically.
And Invesco, obviously quite a big hotels fund.
Yes.
What's happening in terms of that budget versus, I mean...
to be fair, I think in terms of, that's not only a German message which we send out here. I mean, in terms of, we don't look at the stars a hotel is branded with. We just look at the individual concept and how it's working and whether it fits into a city. We just love day cities which are 7-day trading markets. I think that's a key message, generally speaking. So we want to have both business and leisure clientele, but we're just doing basically city hotels more or less.
Okay, good. And in terms of, Nikolai, maybe for you, in terms of offices, what's the expectation from occupiers? Are you having to put more CapEx in? We've done several things on livability, also the office of the future, what that's going to require from occupiers. Is that something that you're looking at now? Is that something that's a trend in Germany?
So you can say that there's a big difference, in my view, let's say between offices or office requirements in CBDs from other locations. Obviously, in the locations that we buy in, it's more about actually the back office space potentially. So there necessarily it's about infrastructure, it's about access to the internet, of course. It's about bandwidth, and then you will have other requirements in the CBDs. But in my view, yes, in the top-notch segment of the office space, that's where you need to always, no matter what asset class it is, that's where you always need to spend the most money to basically also create the highest rents and the highest yields, or most attractive yields. So from that point of view, I mean, there will always be a market for office space that is well connected to infrastructure, and it doesn't necessarily always have to be the most exclusive. It has to cater basically a certain demand and a certain requirements, but those are not so, I would say, dynamically changing like it may be in the core segment, where you could basically buy a building in Frankfurt, and then five years later it will be maybe out of date because there's something, and then basically the international law firm is going to move to a different building, which has been developed in the meantime. That's not necessarily the case if you go to those other, say, secondary markets, where I think we have a stable situation and long-term view.
One point to add here from a tax perspective, we have had some clients from our international network who actually try to set up residential or office buildings, and they actually thought about providing additional service to their clients. So it was not just about renting, it was about providing additional service. And from a tax point of view, you have to be really careful here, because if you just rent property to your lenders, you're just subject to corporate tax in Germany, which is about 15%. But if you provide additional services, it's considered to be a commercial activity, so you are subject to payments to the community. So
Trade tax.
Or trade tax.
Trade tax.
Yeah, so you really have to be careful in this case, or structure it in a certain way that a different company is providing the services. So that's one aspect you really have to be aware of.
I would like to draw the focus on liquidity in the asset classes. I mean, what buildings are really available? If you see what is built new, developments, the bigger part, at least at logistics and light industrial, is built for own funds. You just don't see it. You see leasing activities, but then it's gone. Yeah, and then afterwards you see it when it's the right market situation. You see that big portfolios come on the market, and then the question is how the portfolio is mixed. Yeah, so our business and a few others of the mid-sized and smaller developers is also not to have own funds, so to bring some availability. And I think in the other asset classes also, I mean, you see a lot of things that are simply put into funds and are gone. So even though the market volume is very big, the availability of product is limited.
Okay, good. One interesting point, Tobias, maybe for you. In terms of those cities, Berlin had been viewed for a long time as really not having a significant attraction for office, that it was really kind of a media town. But that seems to be changing in terms of its attractiveness, and certainly there was a company that had been looking at London and had decided to not base itself in London but to base itself in Berlin because of affordability, ability to be able to attract talent. What's your sense of that? Do you think Berlin, its problems with trying to get an airport aside, do you think that Berlin is set to be a big growth area potentially?
I'm not sure if I'm the right person to answer this question, because I live in Frankfurt for the last 20 years. I really do love Frankfurt, and I'm not sure about Berlin. I've seen a lot of positive development. I even spent my holidays last year in Berlin together with my family, just to get to know the city. And I'm sure, since it's our capital, it's our biggest city, it will have a very positive development over the next decades. But earlier today I had a conversation with a local developer who complained about the mafia behavior of the authorities when developers want to create residential. And I'm not going into detail, but as long as we still have the red-green coalition in Berlin, I don't see a real positive new developments in residential, but in terms of office and then commercial developments, it will surely have a positive development over the next years.
Okay, good. I was actually going to invite the mayor of Berlin as a surprise guest, but I'll
go ahead. Go ahead.
Yeah. For logistics, short sentence. Berlin is an agglomeration with 4.5 or 5 million people, and companies, they need to be served with logistics and other services, full stop. No things around. There's a lot of nice vicinity, nice to go on a vacation or whatever, nice golf courses, but it's the town, that's it. And therefore it's an attractive, good market, but it's no growth area because Leipzig is, I think, 150 kilometers away, Magdeburg also, and so it's the town and that's it.
Okay.
I think from a more holistic point of view, the commercial market will follow the residential market from my point of view. So we talked that over before. If you run a company, you need employees. These employees have to live somewhere, so you need residential units for them. You need an infrastructure. I talked to a guy a couple of hours before, and he told me he came from Switzerland. It took him 3 hours to get to Munich and 2.5 hours to get through Munich. So sometimes it's not the best idea to be in an A city because there are a lot of things that are better in the other locations. And for that reason also, if you're thinking about Berlin, it's getting harder and harder to get an apartment which you can afford. And for that reason, sometimes cities next to Berlin or next to the capital city or next to top A cities are an option for the company and also for the employees to live.
Okay, good.
I might be a little biased because I was born and raised in Berlin, and I live in Berlin again. Yeah, if you want to hear my opinion, which might be subjective, if you take Munich, for example, there was nothing here 60 years ago. Yeah, so industries developed, jobs came here, and it took a very positive development. And nowadays we're talking about a totally different Munich than what it used to be. Now with Berlin, it's a similar situation. You cannot expect basically companies to relocate to Berlin and then basically leave other parts. We're talking about new industries. We're talking about tech. We're talking about IT, and there might be market corrections there also. But I think in the long run, what are we talking about in Berlin? We're talking about 3 universities. If you take Potsdam in addition, it's actually 4. We're talking about 17 colleges. So we're talking about so much talent that is being basically, that is in the city, young people, and quality of life, that there's always going to be a demand for that talent, and for that reason also companies deciding to either start in Berlin or locate or open branches, and it's going to be new industries. But in my view, we are, if you take those 60 years, we are halfway through. I mean, the wall came down about 30 years ago. And I personally think that the next 30 years are going to be very exciting for Berlin. It's a growth area. Yes, it is the city. There's not much around it, I have to say. But then again, if you go outside the city, you will find lakes, you will find beautiful forests, you will find a lot of quality of life. And we're not talking about a commute of 2 hours from London City to your countryside. We're talking about being on your boat within 20 minutes. And in my view, I was skeptical about Berlin, but now is incorrect because I moved back 5 years ago. But what I have seen over the past 5 years, I think is going to last for a long period of time.
Yeah.
At the opening, Nikolai said that he's going to explain why he's willing to sell the residential assets. And can you clarify that point, please?
Yes, simply because, you need to look at asset classes separately, and in terms of the cycle in general. Take Berlin. 15 years ago, we had in Berlin about 13% vacancy rates. So you had apartments. You could basically choose where to live. And I knew people who did apartment hopping. So they decided for 1 year I'm going to live here, and then I'm going to live there. And then you had a lot of fluctuation and so on. Nowadays, people are sticky to their apartments because they know if I move out, I'm not going to find the same quality or at the same price again. So that has changed. That also means that developments were very scarce over the past 10 years, 15 years. So now we're talking about a different market. Now again, if you take supply and demand, then a lot of demand has been generated. Supply has been, I would say, very low. And in that context, we have seen rising prices. And of course, people are expecting more to come, and that's why they take certain risks, and that's why yields have really compressed a lot. So if you take Berlin residential buildings, you will probably be down to 3 or 2.5%, which in turn means that you are not going to generate so much ongoing cash flow. You might participate in value appreciation in the future, but that's not for sure. And then what you said, Marcus, if the commercial market basically follows the residential market, there's more opportunities in the commercial market these days, because we haven't seen yield compression there to that extent. In core product, okay, but not in those other markets.
Okay, good. Any other points? I've got one last one, which is, if we were going to invest, because everybody here would like to invest in Germany, where should we invest? Let's start with you, Marcus, and work our way down here. Just what is your investment conclusion from this?
For me, it's pretty simple. So buy our stock. Yeah. So you have a perfect diversification. You're invested in secondary locations. You're invested in offices. You're invested in logistics and retail, food-anchored retail. So a little bit out of the e-commerce slot. And for that reason, from my point of view, if you're not willing to invest in direct investments, that's the best way to do.
Okay, so listed market, preferably yours. Okay, good.
Is there something else? No.
I think what we rightly described here, the market has broad opportunities, first of all, in Germany, also across the risk spectrum still. So I think also looking beyond the pure plain CBD core product, I think makes very good sense, given the strong fundamentals. I think that's the message we still can send out here. Yeah, and then also looking beyond the top 5 or top 7.
Okay, great. Tobias.
We have more than 400 cities, in excess of 30,000 people living there. So this is the locations I would go. But not high street retail or office buildings, but I would buy, say, business park type light industrial buildings in the commercial areas of these cities at a volume of maximum 5 million euros. Because for these properties, you still get decent yields, way in excess of 6%. And yeah, you may not have the yield compression, but stable income over the next decades.
Okay, good. I'm guessing logistics, Christian, but you may surprise me.
No, same-day delivery is the big thing coming up. And even though you have a stable mix, a lot of things coming up, but I think every activity pushing same-day delivery, let's say in multi-tenant facilities, big ones, perfectly located, is a great investment for the future.
So more inner city, urban locations, or just outside the city?
I don't believe in inner city logistic facilities. That's not working. You have conflicts with people living there. I wouldn't like to have trucks running back and forth in a city all the time. So this is a tough one, even with hybrid or electrical powered trucks. But I mean, we have a good zoning plan. Normally, you can be very near to town centers, which is good enough for hybrid cars. And it is very clear that the mix with same day in Germany, we're not where we could be compared to other countries, especially the US and UK. So this will come.
Okay, great.
Yeah, I want to mention, or not to be repetitive, that it's not only important what you buy, it's also important like how you buy it. Like whether you invest directly in Germany or through a partnership or cooperation, because it's like so much to consider from a legal point of view, and at the moment it's changing with regard to real estate tax. There's the base erosion and profit initiative on an OECD level. So there are some changes that are going to affect real estate as well. So I want to emphasize at this point that it's really important to keep this in mind at an early stage when doing your profit and loss perspectives.
Okay, great. And Nikolai, last but not least.
Last time we came together in London, I said it's hard for me to argue for something that we're not doing anyway. So yeah, of course, office is interesting. Office is interesting because there is no construction basically also in that niche. We have the shift to renewable energies, which was supposed to happen by 2050, which in turn mean high energy standards and which makes construction very expensive. That will mean that with the supply-demand dynamics, there's not additional space coming to the market. So it's simply impossible for a developer to develop at the €1,000 or 1,500. So nowadays the costs are much higher, which means that we will see scarcity in office space for the time being. We see a good developing economy, and for that reason, there's going to be demand in office space. And with that demand overhang, it's good to be in offices.